I am a basketball fan, and I am 5'10". Okay,
True.
this is just
I won.
all right. This is going to be. You're going to make a choice on this one. You're not going to say BS or true. You're going to choose one or the other.
All right. What is up, and welcome back to another super awesome, exciting episode of How to Invest in Commercial Real Estate. I just manifested it right there. You guys feel it?
Are you not entertained?
Are you not yet entertained? All right. So this year we decided we wanted to do something new. We wanted to meet more people.
Yeah.
It's really important to Brian.
We used to
I'm tagging
know.
along.
We used to know every investor through friends, family, coworkers, and we've gotten to the point where we don't know all the investors. We have people signing up through various investor groups and Facebook ads that we haven't had a chance to meet. So we decided once a quarter we're going to pick a major city,
A U.S. tour.
and then have kind of an investor open.
We're getting a bus.
Yeah,
You can buy T-shirts.
and just be able to buy dinner and drinks and meet people that have trusted us with their money and allow them to ask questions and thank us for all the good deals and get mad at us for the few that haven't gone the way we wanted them to. So
what's the first one, Braden?
So we're doing Dallas, guys. It'll
When
be
is
fun. March 26th. Anyway, we're going to book some space at a nice big restaurant. Hopefully have a meet and greet, have some hors d'oeuvres, have some drinks, shake some hands, kiss some babies.
all right, well, we're going to start this show off with something a little bit hopefully more interesting than normal commercial real estate stuff. It's called I Call BS. I Call BS. So I've got a couple of things a couple of facts I'm going to say. And
Are we
you
going to keep
guys-
score?
You can.
By the way, what happens if I just totally destroy Brian again?
Yeah, we'll have to come up with a different game.
We're going to have to come up with a better prize.
All right, I'll try to keep score. Brian.
You were going to do B and B, weren't you?
Yeah, Braden.
Word.
I quickly pivoted.
To BR.
Okay. You guys can both get them right. It's about 9 or 10 questions. So here we go. First one. Paying your advisor 1% annual investment fee over 40 years can cost you roughly 25% of your final portfolio value.
I think it's BS.
He's going to get us on like 22 or something. I
won't ever have it that close, by the way.
Okay. Then I'd say 40 years.
Mm-hmm.
I'd say it's true.
I think it's more, but okay. Write it down.
Okay. You said true, and he said false.
Yeah,
Or
just give
false.
us- give us
It
a-
is a third of your portfolio value, not 25%.
Boom.
So Brian got it. Okay, here we go. This one you got to say quick. It's pretty easy one. A portfolio earning 10% annually doubles every 10 years.
False.
I would say false.
Okay, you're both right.
He's just going to say what I
Yeah,
say.
yeah, that's right. It is every
first this
7.
time.
Is every 7 years approximately. Okay,
I knew that.
Let's see.
That's why it's
Brian
false.
loses one time. This is what happens when you talk shit to Brian.
All right. At 7% annual returns, money roughly quadruples over 40 years.
You go first, Braden, because
False.
I think it's false too.
Yeah, it grows 15 times,
Yeah.
guys. 15 times.
I knew that.
All right. Let's see.
I may not miss one.
I don't want to do that one.
Wow. Did you hear this, guys?
It often costs more to buy stabilized assets than it does to build new.
False.
Yeah, that's false.
That's right.
Now look who's copying.
Okay, I'll go first.
Yeah.
It does cost more to build brand new than just
Yeah.
buying income producing shopping centers. That's why I would rather us do more of that.
Yeah. Me too.
Me three.
Braden.
So has Brian gotten them all?
Yeah.
Okay. And Braden's missed one.
Yeah.
Okay.
I love how we're reaffirming this, but yes.
The stock market often performs best when the data looks the worst.
What kind of question is this?
I'm
when
gonna
the data?
I'm gonna say true.
I would say true as well.
Yeah, counterintuitive, but guys, if all the information is doom and gloom, most of that is going to be baked into the market, and so you're probably it's probably a decent time to start buying. Okay,
I think what we're learning is Braden needs to buy all the properties at the proper cap rate, like last week's show, and I need to make all the financial decisions.
Okay, here's a fun one. The top 20 richest individuals in the world,
Real estate.
right? They control as much wealth as 2.5 billion people.
The top 10%.
20 people.
The top 20 people.
Top 20 individuals.
As much as what?
2.5 billion people.
I think it's more people.
Wait, what 2.5 billion? Is it the next?
Any
The
2.5
bottom
billion.
2.5 billion.
Bottom 2.5 billion. Okay, that's.
So the question is more. They control more money.
Control more money than the
then
bottom.
Yeah.
I'm gonna say.
I said as much wealth as the bottom 2.5 billion.
Yeah, I would say that's true.
That's true.
Actually, it's double that.
Ooh.
20 individuals control as much wealth as the bottom 4 to 5 billion.
Wow.
So you both got that wrong.
I didn't even know there's that many
Right.
people on Earth.
Only one wrong.
We got to
two-
work on the phrasing of these questions.
Yeah.
Can I agree with that? This was
Yeah,
Joel's fault.
I think that one, we have to throw that one out.
Okay, here's one. If you start saving at 22
Yep.
and you save $1,000 a month
Okay.
till you're 65, and you're making 10% return, and then another person starts saving at 35 and they're saving $5,000 a month and earning the same 10%, who has more money at 65?
22.
22.
Wrong. It's close. 11 million for the 5,000 a month and 8.6 for the 1,000.
Yeah.
But very close.
Yeah.
And he's saving 5 times as much.
Yeah.
So you both missed that. Brady missed 3. Brian, you missed 2. Okay, just a couple more. Apartments have been the best performing real estate asset class since 2000.
False.
I think that's false too.
What is it?
Wait. I guess we're locked.
I don't, since 2000, I don't think so. Since 2000? Before that, maybe.
That wasn't the question, man. That wasn't the question. False.
Okay, I'm just asking if you guys know what it is.
Not all retail?
Since 2000. Industrial, maybe.
Yeah, industrial.
Self-storage
Oh.
Yeah, so I'm right.
has delivered the highest returns, according to my sources.
It's an iteration of industrial.
But you guys both got it right. Okay, last question.
I got it more right. Let's be honest.
I got a tie at least locked in.
I am a basketball fan, and I am 5'10". Okay,
True.
this is just
I won.
all right. This is going to be. You're going to make a choice on this one. You're not going to say BS or true. You're going to choose one or the other. Do I have a greater chance of being a billionaire or playing in the NBA?
Greater chance of being a billionaire.
Billionaire for sure. You're never
Yes,
gonna make the,
a greater chance of being a billionaire. So why did I spend any time playing basketball is the question.
yeah, you should have been.
I should have been working on money. All right.
That's funny.
Well, Brian, you won by 1.
By a hair.
Yeah.
That's
So
all it takes.
Brian wins this week's I Call BS. All right. So going into the meat of the show, we're talking about macro trends going into 2026. And the overall thing that I researched that was kind of coming across is real estate is not booming, but it is. I know this chair is. Real estate's not booming, but it's doing pretty good and it's stabilizing across all sectors.
Did you have to read that off your screen?
No.
Okay, good.
No. So there's 65% of industry leaders expect, I'm reading this.
Okay.
Expect fundamentals like leasing activity, vacancies, and cost of capital to improve throughout 2026. And we think we're in a good spot because we don't know for sure, but we think interest rates are going to keep working their way down, which will help us refinance properties and improve cash flow across the portfolio. So I think industrial's next. Braden, what do you got for industrial?
I'm
Brian?
industrial.
It is.
So
Best performing asset class since 2000.
No, that was self-storage.
self-storage.
That's kind of like industrial.
Actually, industrial. You know, if you read information online, it makes it sound like industrial is really just plummeting, but it's really not. It was really hot in 2020 through 2022. It was really hot. As a matter of fact, we talked about it. It's probably a good thing we didn't because since then it's been underperforming, but it's stabilizing. So vacancy has stabilized around 7% nationwide. So what's happening now is people are not building industrial for speculative reasons, right? So 40% of what's under construction right now is specialized and build to suit, as opposed to in the past where it was like 10%.
Yeah, we had the cannabis craze, then we had the COVID craze, and now we've got not the data centers, but we've got the fulfillment centers. They were huge. So now the next thing I think is we have these data centers, data storage for all this AI stuff. Is that still in the considered industrial?
It is. So I think that's helping a lot. And
It's hard to retrofit, it's hard to revamp it. A lot of that stuff is new construction.
Yeah, and a lot of those, a lot of the larger facilities are what's taking up the capacity now. So rents are up 1.5% year over year in 2025, and they were double-digit increases back in 2020 and 2022.
Wow. So it's just cooled off.
Yeah, so it's cooled off. But experts are saying, larger brokerage houses are saying that it's starting to catch up. The building cooled off with the higher interest rates and the increase in building, and so it's starting to stabilize at this point.
Nice.
Anytime you have new supply, it's going to put pressure on absorption of existing stuff in any asset class, even if it's houses, right?
Yeah. That's kind of helped us in retail too, right? There wasn't a lot of new construction since 2020.
Be careful. Don't take my stuff now, Brian. Don't take
He's already
my notes.
Oh, sorry.
Okay, I've got office, and so I got a couple of macro trends to discuss.
It sucks.
Well, it was in free fall during COVID, right? The offices were shut down, and we're figuring out we have Zoom and we have all these tools, and we don't really need to go into the office in a physical location. But what I found in looking up vacancy rate trends in office is that they're basically flatlined the last 3 years at 19, 20, 21%.
Gosh, vacant.
So
20% vacant.
Yeah, it's not healthy, but it's found a ceiling. It's kind of found a new normal, I guess is what I would say. The other thing is a big push is to try to convert some of that office to some other use. And residential is one key because a lot of these office buildings are downtown and they want to get people into these buildings. But what I found is it's a lot more expensive than you would think, and only about 25% of offices are even viable to make that shift.
To multi-housing.
To multifamily housing, yeah. And then let's see, I got two other points. Value versus the refinancing wall. Like you've got this huge glut of refinancing that needs to happen on all these offices. The problem is the offices are worth 25% less than they used to be just because of the free fall after COVID. So that's putting a lot of pressure on people that need to refinance and they can't, or they don't have the money to do it. And so we're going to see potentially more foreclosures or more properties trading hands in the near future. And then the last point, I just looked at like major metros versus small and mid-tier. And really what I found is if you're in office, you want to have the best located, nicest office. There's a flight to quality and to safety. If you're in a major market that's got a glut of central business district office and you have a C-class office, you're going to struggle maybe for years. So that was my takeaways on office. I'm still not going to be buying office anytime soon unless it's a very select use. You can get some long-term, lease with a really good tenant.
Yeah.
Retail. Quietly the tightest asset class out there. Retail isn't making headlines, and that's exactly why it's outperforming. So according to the National Retail Federation and major brokerage data, U.S. retail vacancies have dropped to 4 to 4.5%.
Nice.
Which is the lowest it's ever been.
So 4% for retail, 7% industrial, 20% for office.
Yep. So, we talked about nobody's bringing new supply to retail. It's a very, very select few. And when it is, it's small, 11,000 square foot buildings built to suit for shop space tenants. So rents have been going up.
That's good for us. We own a lot of retail.
Yeah. According to the data, rent growth is modest at 2 to 4%. We've seen that's national average. They're taking in, major MSAs and everything like that. We've obviously seen a lot higher rent growth number than that. But we're in a lot smaller markets.
So we try to get 3% annual increases. So that means compounding. Now we're pushing this year to get 4% annual increases on all new leases. And so I really challenged my leasing people, like get to the no before you get to a yes. Try to get them on the hook for 4%. So anyway, that's the trend we're seeing.
Yeah, the other thing is store closures. Generally speaking, a lot of retail people are still very bullish over low weighted average lease term, month-to-month tenants, short expiring tenants. This is all stuff that we look for as retail investors, and other people do, because the probability that you're getting a new, better, higher paying tenant is very probable, right? And it's not bad. It's just cleaning out some of the crap. You're always going to have these shifts in retail concepts. And we can tell because the vacancy, like we said, is the lowest it's ever been at 4 to 4.5%. So those are immediately being taken back up and released by new, better concepts.
All right, I like it. Got a new segment.
New segment. Worst deal we saw this week. Worst deal of the week. So we're going to try not to take a shit on a bunch of other people's deals, but in looking at tons of deals, we figured, hey, let's just save the folder. We'll shove a bunch of just some of the worst deals we've seen. So it is a McDonald's.
Okay.
More specifically, it's a McDonald's ground lease. Why do I highlight this? Because you can't depreciate it, guys. You've got nothing in rent. You've got maybe $80,000 rent. You're buying a $2.8 million ground lease. I think it's a 3.5 cap. It's a 3.5 cap, guys.
Wow, I'm looking at it. Yeah, 3.5
It is
cap.
in the middle of nowhere. It's in Kentucky, not like Kentucky, in the entire Kentucky is in the middle of nowhere, but this property in this city in Kentucky is literally in the middle of nowhere. It's right next to a Walmart. It says the store sales are great, sure, whatever. 3.5 cap, and it's a ground lease. You don't even get to depreciate it. So I just thought, hey, there's got to be better options. If I just love McDonald's as an investing mechanism, how could I get involved in McDonald's other than this crappy deal in the middle of nowhere, Kentucky? And I did some research, and 5 years ago, if you would have bought any amount of McDonald's stock, but let's just say $2.8 million, like the cost of this ground lease, you'd be up 48% in 5 years. 48% in 5 years, guys. If you want to invest in McDonald's, go buy the stock.
Yeah, really.
Don't worry about these 3.5 cap ground leases. Who's buying this?
I don't know. What happens if it's owned by a franchisee and the franchisee goes out of business or goes bankrupt?
I'm sure corporate will probably take it over or something. I don't know. Otherwise, you get a free McDonald's that you get to sublease to somebody else.
Yeah.
Traffic counts are nominal. It's in a mountain town.
That is crazy, man.
I don't know why.
I look at, and also they've got 40 years on this ground lease if you include the option. So the rent in 40 years doubles. That's it. It doubles in 40 years. It should almost triple or quadruple in 4 years. And so that's pretty minimal.
You found a bad deal.
And so you're literally earning, I wonder why someone does that. They're earning 3.5% on their money with no tax advantage. So like right now, a 10-year treasury is like 4.25. Okay. So you're getting, basically 25% more return just buying T-bills. Yeah. I can't imagine why someone would think that's a great idea.
Yeah.
It's a horrible idea. And that's why it's the worst deal we saw this week.
All right. Anything else?
I think that's it. We'll be back here next week with another awesome episode.
All right. And
Thanks,
some more
guys.
games.
Yeah.